Welcome, everyone. Today we're covering Chapter 9, Budgeting for Business Operations. This is a foundational chapter because budgeting is one of the most important planning and control tools in any organization. Budgets help businesses plan their operations, coordinate departments, allocate resources, and evaluate performance. In this chapter, we will walk through the budgeting cycle and then learn how to prepare a full master budget for a manufacturing company. Here are the learning objectives for Chapter 9. At the end of this chapter, you should be able to describe the purpose of budgeting and the budget cycle, discuss how to plan for budget preparation, describe how businesses use technology when budgeting, and prepare a master budget. Before we begin, let's connect budgeting to real life. Preparing a personal budget is one of the best ways to avoid debt and maintain financial stability. A strong personal budget requires separating needs from wants. A budget helps ensure that money is available for the most important priorities. Businesses use operating budgets for the same reasons: to control spending, plan ahead, and avoid financial surprises. Let's start with a quick review from Chapter 8 and capital budgeting. Capital budgeting focuses on large, long-term investments such as equipment purchases, faculty expansions, and new ventures. Common capital budgeting tools include average rate of return, payback, net present value, and internal rate of return methods. Operating budgeting, on the other hand, is our focus today. It deals with the company's daily operations over a defined period, usually 1 year. Operating budgets forecast sales, production, costs, and cash flows. Now complete learning activity 9.1. You're giving two investment alternatives, a pizza oven or a braising oven. You will compute the net present value and internal rate of return for both options using a 15% hurdle rate. The purpose of this activity is to reinforce the capital budgeting concepts we learned in Chapter 8 and to remind us that investment decisions require time value of money analysis. Pause here and work through the activity. Once you've finished, check your answers with the solution provided in the back of Chapter 9. Now let's go into Section 9.1 and describe the purpose of budgeting and the budget cycle. Capital budgeting, covered previously, focuses on large investments like equipment or business ventures. An operating budget is a financial plan that outlines expected revenues and expenses over a defined period. The purpose of budgeting is to help businesses plan for resource needs, provide benchmarks for evaluating performance, support managerial control, identify inefficiencies, and assign responsibility across departments. Budgeting provides structure, accountability, and a way to measure whether the company is meeting its goals. Why do budgets matter? Budgets matter because they guide daily decision making. Without a budget, managers may overspend or allocate resources inefficiently. Budgets also help coordinate departments. For example, if sales expects high demand, production must increase output, purchasing must buy more materials, and human resources may need to hire additional workers. So budgets create alignment across the organization. Now let's look at Learning Objective 9.2 and discuss how to plan for the preparation of the budget. The budget cycle is the process of preparing a budget, implementing it, and comparing actual performance to budgeted expectations. This comparison is called variance analysis. When variances occur, managers investigate why performance differed from expectations and adjust operations for future budgets accordingly. Budgeting is not a one-time activity. It is a continuous cycle of planning and evaluation. A master budget is a combination of the functional level budgets that incorporates a cash forecast and projected financial statements. The master budget includes schedules for sales, production, purchases of materials and supplies, direct labor, wages, overhead expenditures, capital expenditures, and selling administrative expenses. All of those budgets get compiled into cash budgets and projected or pro forma financial statements, such as an income statement and balance sheets. Now evaluate Learning Activity 9.2. Which budget is the most difficult to compute, but most essential for accuracy? Pause here and work through the activity, and once you've finished, check your answer with the solution in the back of Chapter 9. Now let's talk about how businesses use technology when budgeting. A Harvard Business Review survey found that 90% of companies use spreadsheets for budgeting. Why are spreadsheets so popular? Well, spreadsheets are easily customizable and adaptable to business needs. They have built-in functions, computational and statistical, that simplify calculations, and they're low cost and require minimal training for users, as spreadsheets are already widely used across organizations. There are some other key advantages of using spreadsheets. Some benefits include integration capabilities. They can easily be combined with other tools and data sources. They're also very flexible. They can be tailored for any type of budget, for instance, an operational budget, or a capital budget, or a sales budget. They're very cost effective. They're relatively inexpensive software options that are commonly already adopted by organizations. And they're user friendly. They require little training for basic budgeting functions.